next up, we have Brant Tomey. Brant is the Director of Insurance Sales at Equitable Life. His session is titled 5 Reasons Why Participating Life Insurance is a Unique Asset Class. You can expect to learn how to position par insurance for your high net worth clients and understand mutual versus stock company dynamics. Brant, welcome. Nice to see you in a tie. Thanks for dressing up for us. Appreciate it. The virtual stage is yours.
Thank you, everyone, for joining here today. I see we have a ton of attendees. Very impressive. I'm thrilled to be here today. I was either going to be uplifted by the Game 7 last night, or I was going to be an absolute train wreck. So you should get a quality version of me today as I deliver a tremendous presentation. So the presentation here today was put together by our advanced case team and our marketing team. They did a great job of delivering a unique perspective on life insurance, that it can do more than simply address a client's needs, but that it can become a integral piece of a client's investment portfolio as well, especially for our high net worth clients. Now, this perspective might seem a little revolutionary. Many of you have heard a version of this in the past. For some, this will be a brand new introduction to the idea. But par whole life insurance specifically is structured in such a way that our high net worth clients can absolutely benefit from integrating par whole life insurance into their life, not just for their insurance needs, but to actually enhance their wealth while they are alive and their estate when they pass on. So a little bit about the genesis and the origin of this idea and this strategy. What would happen in North America as par whole life was being positioned by insurance advisors, a lot of the time, especially to high net worth clients who have accountants and sometimes tax lawyers at their beck and call, is we would position life insurance strategies, and we would not necessarily be able to get the sign off from the other experts in a client's life. So we'd be able to, position a permanent insurance policy, and a lot of the time, when that strategy made its way to the accountant, or again, a tax lawyer or any other type of advisor, investment advisors in many cases, the strategy would change a little bit and the accountant might recommend something like a term. Ultimately, there are certainly times when term makes the most sense. Accountants are not always wrong in that regard, but par whole life, when viewed as part of an investment strategy, can complement the wealth of our wealthy and growing wealthy clients. So what happened is, in the United States, the Guardian commissioned a paper by a gentleman, a white paper named Dick Weber. And effectively what the approach was to look at par whole life insurance as a unique asset class from a very analytical and mathematical standpoint. Effectively, what they were trying to do is convince the other experts in a client's life that par whole life insurance was more than simply an insurance sale, but it was something that could actually enhance their wealth during their life, and again, their estate when they passed on as well. So in 2008, Dick Weber put forward the first paper on this, and it was based in the United States. And Wayne Miller, who was at the time a senior actuary at Sun Life up here in Canada, did a Canadian version of this piece in 2012. It was later modified slightly for an Advocates paper in 2013. And this analysis for the Canadian marketplace had a huge impact on the insurance industry. All of a sudden, we were able to mathematically quantify the importance of par whole life insurance for our wealthy clients, and we could actually convince them to move forward with some large premium cases. This impact was gone, but not forgotten, years and years and years down the road. And effectively, what we wanted to do was partner with Wayne Miller to create a brand new version of this, and we have done that. And this is what I'll be presenting on here today. The wait is over for a brand new look at this strategy. Life insurance as an asset class, the Mutuality Edition, was put out last year by Equitable in partnership with Wayne Miller, the very same Wayne Miller who put forward the first articles, as a way to refresh this for modern times and also position it from the standpoint of a mutual company and why it might be important to work with a mutual company when you are looking at par whole life insurance as a unique asset class. So let's set the stage a little bit here. I mentioned clients wanting and needing insurance. As our advanced case team would say, there's effectively two types of insurance clients. There are those clients who need it, and we know these clients. We run into them every day. We coach soccer with them. We see them at the grocery store. People need to replace their income. They need to pay off their mortgage if the worst case scenario happens to them. They may need education funds for their children, grandchildren. We need to buy out shares in the corporate world, buy, sell agreements and things of that nature, or even just pay off corporate loans that exist as well. Clients who need insurance, a lot of the time, will move towards a cost-effective insurance approach. Term 10s, term 20s, term 30s, even things like level cost of insurance, T100s or level cost ULs. But for the clients who can actually wrap their head around what life insurance can do for them during their life and for their estate and their legacy, they will want permanent life insurance. And they will want permanent life insurance specifically because it is an unmatched tool when it comes to creating and preserving wealth. There's nothing like it. Okay, I mentioned baseball once already. We've got Shohei Ohtani in the World Series. He's pitching and leadoff hitter for the Dodgers. That is an unprecedented impact on a baseball team. Permanent insurance is the exact same thing. Ultimately, for our clients who have accumulated wealth, there is no better way to grow that wealth, both during their lifetime and when they pass away, than with permanent life insurance. But can life insurance, and I've lauded it and praised it, can life insurance actually be considered a unique asset class? In other words, if a client's looking at a portfolio of their assets, can we view life insurance not just as a potential option within the asset classes, but a unique asset class in and of itself? We'll set out to answer that today. So what types of asset classes exist? We've got effectively cash and cash equivalents, fixed income. A lot of the time we're talking about bonds, whether it's corporate or government in that scenario. Real estate, equities, which most people think about when they think investments. They think of the market at large. And alternative investments. So we talk about everything else that kind of fits into the world, crypto, other currency type investments, and so on and so forth. These are the traditional primary asset classes. When we talk about high net worth clients, it's important to get a little context on who we're talking about here. Now, your clients may or may not have achieved this goal, but the analysis here today will benefit not just your high net worth clients, but those on their way, and those who are accumulating wealth in any way, shape, or form. There's an interesting report that goes out every year. It's called the World Wealth Report, and it's put together by Capgemini. And effectively what they do is they look at how high net worth individuals across the globe manage their wealth. What's extremely interesting, and there's I'm sure a lot of psychology behind this, is the fact that high net worth clients generally look to preserve their wealth first and grow their wealth second. What you'll see on the screen here is how high net worth individuals in this Capgemini report are distributing their assets. And what we effectively see here is that anywhere between 40 and 50% of high net worth individuals' portfolios on average are going to be in what we would consider to be safe assets. In 2023, the most recent data we've got for this presentation here, we see that fixed income and cash equivalents make up about 50% of high net worth individuals' portfolios. That effectively reinforces what we've said, that those who have achieved wealth look to preserve it first and then grow it. So if we're looking at them versus other types of clients, we would actually look at them as more likely to use safe assets as a foundational piece of their portfolio. So let's talk a little bit about diversification. Diversification of asset classes is an accepted way to reduce risk and increase reward or increase interest. Diversification strategies. A lot of the time, I think we talk about diversification as, well, I've got 6 or 7 different um, companies in my stock portfolio, but there are a lot of ways to diversify. Okay. Well, I think we all know 1 or 2 people who are diversified across all the cryptocurrencies, but of course we know that's all kind of jammed into one corner. Um, we can diversify based on asset classes that we use. We can diversify based on the geography where our investments are in part of the world, industry or sector, duration, correlation, effectively, making sure that our investments are not linked um, as markets go up and down. And knowing what asset class to choose is not easy. Okay, there are many professionals here on the line here. You've had good years, you've had bad years. You've had good portfolio constructions, you've had bad portfolio constructions, and it's certainly not a reflection of of your level of professionalism. The reality is, for the best investment gurus in the world, it's extremely difficult to achieve the perfect level of diversification and to be selective in where we're placing a client's investments throughout their portfolio. Nowadays, we're seeing a lot in the AI world, where AI is, maybe helping us to amplify these investment portfolios, and to varied levels of success. That seems to maybe be certainly something that can assist investment professionals as they move forward. But the reality is, because the future is uncertain, and because market correlations are not always clear, it's extremely difficult to have just a perfect level of diversification and a perfect level of selection in a client's investment portfolio. A model that can help us, though, is modern portfolio theory. So in 1952, Harry Markowitz developed modern portfolio theory as a way of effectively breaking down the correct balance of risk versus return. So what you see on the screen here, you've seen several times before, I'm sure. We effectively have risk and return on this graph, and we've got this beautiful line here, which is our efficient frontier. The efficient frontier shows the correct balance of risk and reward based on modern portfolio theory, which is the basis of a lot of investment strategies nowadays, of course, as you know. So what we're looking to do here is we're looking to use modern portfolio theory, which looks to quantify the correct amount of risk versus reward in a client's investment portfolio. And we're going to throw par whole life insurance specifically up against the modern portfolio theory in order to see if it ends up to the left of our efficient frontier. So do we have increased risk or decreased risk and increased reward by using par whole life insurance as a unique asset class? Do high net worth individuals' portfolios benefit from including permanent life insurance? First question we'll answer. And second, what permanent insurance can be considered a unique asset class? So I've given this away a couple of times here as I talk about permanent insurance back and forth between par whole life. Why am I talking about par whole life exclusively? Permanent insurance can be non-par whole life or term to 100. Okay, there are still some non-par whole lives out there, but there's no variable interest. There's no variable interest or investment component within those non-par whole lives or term to 100. If there is a cash surrender value, it's usually guaranteed. And in essence, it reflects cash and cash equivalents or fixed assets as far as the asset classes that already exist. So non-par whole life or term to 100 does not meet the standard as far as being a unique asset class. There are plenty of guaranteed safe investments that are out there. Universal life does have an investment component, as you know. However, every investment that we can access through universal life, we can also access outside of a universal life. So as far as offering something that is truly unique and making UL a unique asset class, it does not have that. So we've ruled out universal life for this as well. Participating whole life is unique for 5 specific reasons that we'll touch on. First is diversification. Second is stability. Third is liquidity, which you wouldn't normally think about with permanent life insurance, but I'll show you where that makes some sense. Tax preferential treatment, as well as how par whole life insurance interacts with the capital dividend account when we have a corporation involved in a client's planning. To make these points, we're going to look at five, or we're going to analyze these five reasons with using a case study. Okay, so we're going to take a non-smoking male, age 50. If you remember our Capgemini report, our high net worth individuals tend to skew towards safer investments, okay, safer assets overall. So he's currently 40% invested in safe assets, specifically in bonds. And what we're going to look to do is we're going to reallocate $100,000 a year from those safe assets, okay, for 15 years to a 20-pay par insurance product. Now, this is the wealth version. There's a base premium, and there's also EDO or ADO, if you're familiar with that term from other carriers. That is extra deposits or additional deposits effectively overfunding a client can do with par whole life insurance. The face amount starts at 1.3 million, and we're going to offset the premium, or effectively the client is going to stop paying premiums out of pocket after 15 years. In order to give a totally conservative and clean look at this, we are going to reflect the dividend scale interest rate at the current rate minus 1%. So that would be 5.4% for us, as we are at 6.4% at dividend scale interest rate. If you have worked with par whole life insurance in the past, you know that that is an extremely conservative and safe outlook. So in no way can this be looked at as, well, you know, you were optimizing the illustration. The reality is this is if anything a pessimistic view at how this par whole life insurance policy would perform in this hypothetical scenario. We're going to use simple marginal and dividend tax rates, and we're going to compare to his current bonds at 4.4% pre-tax rate of return. So let's talk about why we're going to do that. As I mentioned with the Capgemini report, high net worth clients skew towards safe investments. That's great. We've established that. We are going to compare to a client's bond portfolio. And we're going to do that because, generally speaking, par whole life insurance is not known for massive returns on a year-to-year basis. It's known for being stable and consistent and providing a crisp, slow level of return over a long period of time. All right, we'll dive into those numbers here shortly, but the reality is safe assets are the best comparison for our par whole life insurance. So when we are looking to reallocate a client's assets, we're not going to pull from investments that are very different. They can continue invested in high risk, high reward investments. We're going to reallocate from the safe assets. Similar volatility to par, safe assets are also the least tax efficient assets. Many of you are thinking, well, you know, just put it into something registered. The reality is when clients grow and grow and grow wealth, the registered assets or the registered vehicles for them run out relatively quickly. Let's talk about par whole life insurance really, really fast here. Par whole life insurance is a permanent insurance product. It's been around for more than 100 years in this country. And what it does is we're effectively going to build an outlook for the performance of the policy and use very conservative assumptions. So something like 2 to 3% interest. We're going to use 1980s mortality rates. We're going to ask for a premium from the client that is above the simple cost of insurance, and we are going to take the excess and invest it in one big account called the par account. Now, the par account is going to generate investment gains, and we're also going to pay death benefits straight out from the par account. So if we have better than expected mortality and better than expected investment gains, we'll actually end up with growth in the par account. And that is the goal. And that has been the case in this country for over 100 years when we talk about this product. So the difference between the assumptions that we've made on policy performance and how the policy actually performs results in a gain. And that gain can be distributed to policyholders as a dividend. If you have positioned par whole life with your clients in this country, you know par whole life always delivers. And it does deliver simply because it has some unique advantages that make it a unique asset class. So policyholders can expect dividends on a yearly basis, not just with our tremendous company, but with all the tremendous companies in the Canadian marketplace. As you see over time, the dividends that a client looks to receive are generally built from the investment performance of the par account. There is an element here of mortality. So if we pay less death claims than anticipated, we can use that to deliver a strong dividend. Now, the focus of a par account is to create consistency and stability over a long period of time. So what you will end up seeing is that a par account prioritizes staying steady rather than riding the ups and downs of a constantly fluctuating market. We have some unique accounting abilities within a par account that allows us to do that. This presentation won't allow for every element of that, but your local reps, as well as our advanced case team, would love to take you through that anytime. The reality is par whole life and the accounting behind it is very, very unique, which lends itself to being a unique asset class. So let's take our example. Let's look at the 5 reasons. I mentioned the par account. This is what the par account looked like on December 31st, 2024. What you will see is that we are in the bonds market. We are in the equities market. There's also the real estate policy loans, which do have an interest rate. So there is a return there. Private placements, which are non-public lending agreements with blue chip companies, generally speaking, as well as mortgages and then holding some money in cash and cash equivalents. Okay. We are trying to create a stable, steady, predictable return for clients because that is what they're choosing to buy when they move forward with a par whole life insurance policy. Now, stability. What you'll see on that teal line there is a remarkable level of stability. Par accounts in Canada have continued to deliver stability over a long period of time, even with falling interest rates, simply because they don't look to hit home runs. We are consistently trying to achieve a moderate return over a long period of time. And because they keep that focus long, they're able to deliver on that. You see the ups and downs of the S&P TSX composite, and then you see something that we would generally consider to be stable, the Government of Canada bond rate, and you see that teal line there, which is the dividend scale interest rate. So we outperform something we'd consider to be stable, but we actually match and beat the stability of that. We can give PTSD to anyone remembering their university stats classes. But if we look at the standard deviation, which is a measure of volatility, you'll see here the equitable dividend scale interest rate has a very low standard deviation over 30 years, right? Lower than a lot of things we would consider to be extremely stable. Now, as far as liquidity, most people don't think liquidity when they think par whole life insurance. But the reality is, if we structure these the right way, we're able to achieve a lot of cash surrender value, which can be accessed through surrender or policy loan, but that could trigger taxation. Our high net worth individuals or clients who buy large life insurance policies will generally look at a third-party loan using the policy as collateral in order to access that cash. And a lot of the time, what they'll realize is 90 or 100% of their cash surrender value can be accessed when they go through a third-party lender. Nowadays, lenders are very much in the loop as far as how this works. And this has become a very viable strategy, especially when these policies are structured the right way. If we look at cash surrender value and how it would stack up against our 4.4% bond portfolio here, we see that the client suffers a little bit on liquidity early on with the life insurance approach, but the life insurance tax-deferred growth actually gives us more liquidity down the line than what the client used to be invested in our case study. We also have tax preferential treatment with permanent life insurance. The after-tax benefits at death, as you would expect, vastly outperform what the client used to be invested in. What this effectively means is that nothing is better at life insurance or nothing is better at being life insurance than life insurance, right? We can trade cents now for dollars later by using permanent life insurance. It's a tremendous way to preserve wealth, and it's something that high net worth individuals have been doing for a long time. If a client has a corporation involved in their financial planning, and many of these types of clients would, then we also have another massive advantage, which is that the death benefit from a corporate-owned life insurance policy triggers a capital dividend account credit that effectively allows us to flow money from inside the corporation, outside the corporation, when a life insurance benefit has been paid. Effectively means we can trade corporate cents now for personal dollars later. I can make sure that my loved ones receive all the wealth I've built up in my corp by utilizing life insurance in the correct way. And you see that play out on our comparison here. So the 5 reasons why PAR is a unique asset class, it is diversified, remarkably diversified, not just in how it's invested, but also in how it is accounted for. We have the dividend scale interest rate, which is remarkably stable. Client has more liquidity than expected when these are structured the correct way. And that tax-deferred growth gives life insurance a massive advantage over things like a bond portfolio. If a corporation is involved, we have another huge advantage in that we can utilize the capital dividend account credit generated by the life insurance proceeds paying to a corp to flow money from inside the corp, outside the corp without taxation. Referring back to modern portfolio theory, effectively, all these 5 things make it so that par whole life insurance falls to the left of the efficient frontier and is absolutely a unique asset class. Wayne Miller stood on this in 2012, and he has redone it with us recently. We are thrilled about the impact that this has had. And what I will tell you as I sign off here is that advisors who have used this marketing piece, which we'd be more than happy to provide and distribute, have found tremendous success positioning this not just with their more sophisticated clients, but also with centers of influence around them. So the accountants that you work with, real estate people that you work with, investment specific professionals you work with, perhaps to back and forth between investment and insurance. They love this analysis and they love this article specifically because it looks at par whole life insurance not as an insurance sale, but as something that complements and enhances a client's investment portfolio. We love par whole life insurance at Equitable Life. We are a mutual company and we love our par whole life clients. But the reality is your clients will love it even more because of what it will do for them and their wealth during their life and also once they pass on. Thank you, Jonathan. I believe I'm at the
So
end of
good,
my
Brand.
time.
That was awesome. Yeah, right on time too. I love that. Some might say you knocked it out of the park.
Springer style.
Yeah,
Yeah.
you kind of look like George Springer. That's great. Well, this is awesome, Brandon. I know a lot
Thank you.
of advisors are looking to get into that high net worth space, and I love the 5 benefits of using par whole life as an asset class. You cover that very well. I like how you built to it. So thank you so much for sharing. Last question, I guess, is just where can advisors go to learn more about how they might integrate this into their practice?
Yeah, absolutely. So your wholesalers across the country are as versed, if not better versed in this strategy than I am. Um, our advanced case team was integral in putting all of this together, and they've done tremendous work there. The article itself is about 20 pages. It's tremendous. I'll make sure it's distributed in whichever way that IDC sees fit here. And also the slides from this presentation, which give you some time to go through the actual comparison, are going to be made available as well.
Love it. Folks are definitely looking for the slides, which is a good sign. So, Brant, thank
Great.
you. This is great.
Thanks, Jonathan.